Hello and welcome to the Wire's Business Report. Bad news as we close up the week with the Q2 GDP coming in at 4.5%. The good news first, if you want to look at it like that, is that we've been saved the blushes from a 4.2% tick, which is what some estimates were holding at. But to put it into perspective, 4.5% in terms of GDP growth is a 26-quarter low. The last time we saw numbers like this was in Q4 in 2012-2013. To put that in perspective, we were coming out of the Lehman episode and growth had really crunched down in that period, which is why we had a very, very poor tick. What's surprising to me is how people are trying to talk it up, especially on business channels, saying, well, things don't look as bad, but 4.5% for a country this size is frankly an abysmal tick. The bigger problem over here is that full year growth is now in peril. For most economists, it was quite clear that if there was to be a sub 5% tick in Q2, the full year growth target would be pulled down. Some of them did that preemptively, but now there's a 4.5% marker, so growth will get tweaked around, especially for the full year. What is disturbing though is the quality of growth and what's coming in the internals of that figure. Let's talk a little bit about what really let the cat out of the bag. The core numbers came out shortly before the GDP figures did. Core industry has actually contracted by 5.8% in the period up to October. Basically, the main thrust or the main engines of the economy are not working. It's a higher slippage than what we saw in previous quarters, and we're now looking at a serious situation in the core numbers and indeed what's happening with manufacturing. There's more disturbing news for me. What's happened this time is not just manufacturing, which is something that we've been seeing sliding off. Services as well for Q2 has actually contracted to 6.4% versus 7%, which means the twin engines of the economy are both struggling and choking at this point, as the Q2 numbers have indicated. There's a few more finer details that are actually raising some eyebrows. Finance has come in at 5.8% versus 5.9%. It is a small slippage, but what's important to understand is that in this quarter you actually saw banks reporting slightly better numbers. It looked like things were improving, but even then on finances there has been a little bit of a step back. What's also disturbing is what would these numbers have looked like if there wasn't any government expenditure. For example, public administration has come in at 11.6% versus 8.5%. Imagine what the growth would have been if there hadn't been that thrust or that push from the government. Given what's happened with the fiscal deficit and how far the gap has actually reached, because we're now ticking at 102% of our full year estimate, it looks like the government itself may not have that much firepower in terms of pushing in more capital or pushing in spending for the next few quarters. Private consumption has actually improved a little bit at 5% versus 3.1% in the previous quarter. But I think you need to look at this in the light of what's happening seasonally. This was a festive period. There was a little bit of stocking that's happening ahead of the festive period, and that's probably what's bumped the private sector space and its consumption up a little bit. There's a deeper question to ask about these GDP numbers, which is the trust deficit. When you look at the 4.5% number, do you believe what you're seeing? Are there more details over there that have been withheld? Does that 4.5% truly reflect the crunch down that's happened in terms of growth? I think those are questions which remain unanswered and probably will in the quarters ahead. So what from here? As we step into December, the Reserve Bank will meet, they will have their monetary policy meeting, and they will have to do a lot of deep thinking on what's happening with the growth targets, for example. At this point, RBI's full year target stands at a 6.1% tick. It looks like a very, very tall estimate. I mean, forget about the $5 trillion economy, etc. It looks very unlikely the government will be able to, or the Reserve Bank will be able to hold on to that 6.1% for the full year. Let's also look at another barometer which has actually been a greater or a more sensitive indicator of what's been happening. On Friday, the currency closed at 71.74, that's the rupee to the dollar. When we come to trade on Monday, it's very, very likely the currency is going to see a lot more in terms of pressure. And some of that was evident in the bond market. There have been significant outflows happening from the FIIs in the bond market. And I think that reflects the kind of trepidation that they have about what's going on with the internals of the economy at this point. That's one more thing to watch out for. The other thing to watch out for is what rating firms make of this 4.5% tick. Both S&P and Moody's had already put the ratings under watch. They were concerned in what was happening in terms of the fact that investment was not picking up, or consumption, more importantly, was not picking up, and that growth seemed to be stalling, more importantly, stalling for a longer period than they expected. There are a few more details which I think will get glossed over from what you see in the business dailies or what you see on the channels. Farm sector growth. It's not a huge contributor to GDP, but it is a very, very important indicator on what's happening with rural India. For Q2, farm sector growth is at 2.1% versus 4.9%. It's more than halved going into this quarter, which is a big indicator of the kind of distress we've been seeing in the rural space. Bear in mind, the recent NSO survey, which was then clamped down or was not released, did indicate that the money in the hands of the farmer or rural India had actually gone down, which means lesser to spend, less output. Rural India is in deep distress, and I think the government needs to take cognizance of that, and they need to take very, very strong note of what's happening in the rural space in terms of the growth crunch down. Some of the signs were really in the tea leaves already. If you looked at what happened in terms of consumer durables, air travel, auto sales, there was deepening contraction happening, and I think it was all pointing to the fact that this was not going to tot up to be a good number. The bigger question, like I said, is what happens in the second half of the year. The chief economic advisor, of course, has come out and made a comment saying that growth or the fundamentals of the economy remain intact. Q3 could be better. It well may be, because there is a seasonal factor baked into it. But the bigger question is, how much has the country crunched down within the period of this year? What's happening with the core engines, as I mentioned, manufacturing, services? All of them seem to be stalling. And how protracted could this period of low growth be? 4.5% for Q2, the full year GDP now in doubt, and the period of contraction, the period of pain in terms of growth seems like it's gotten extended as well this time.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.